Hello, everyone. I'm Steve Ankerstar, founder and CEO of Ankerstar Wealth, and welcome to the third quarter investment advisory board meeting for Ankerstar Wealth. As you can see, the 5 board members are there listed above, and 2 of those are new. Welcome to Michael Goltz, is now a board member, and also to Joel Hansen, who is also an advisor as well. So both are clients, and one of them is an advisor, but we like having their expertise and experience on our board and look forward to their valuable insights as we move forward. For the structure of this briefing, it is a webinar format, so you only see me. Nobody sees who else is on here. But however, if you want to chat with each other, there's a chat window. I do not monitor that. There's a Q&A window if you want to ask a question or have a question about any investment on here, whether you're a board member or just someone listening in. Please go ahead and put your question in the Q&A session. I will see that. I may not deal with your question right away, but that's what the purpose of that window is. So you pop that up there, and then I will get to it either real time or there towards the end. Before we get started, a lot of good news. I mean, you're right. It's going to be a tough briefing for the investment side of it because of the quarter we just had, and but in the worst start in 52 years for the market. But on the good news side, I am recording this during the 4th of July, so hopefully you're enjoying a fantastic weekend with your friends and or family, celebrating the birth of this great nation. Obviously, we have our issues as the United States, but it's still the greatest nation on earth. So thanks for getting out there and celebrating that. I would only hope that the haters on Twitter that are threatening to leave the U.S. At least keep their nastiness to themselves during the nation's birthday, right? But everybody has a right to their opinion. But if you'd rather be somewhere else, there are exits all over on all 4 sides of the country to take to take us up on that. Also good news. Let's see. Top Gun event was this quarter. So if you were around, I believe it was in the April 25th. I can't remember now. It's going so fast. We had the big Top Gun event, May 25th. Super exciting to be able to, obviously I had to be in the local area to kind of take advantage of that, but super exciting to have my first real client event. So thanks to Jaden and Candace for help putting that on. They did a lot of the background work, not only for organizing that, but, figuring out where everybody's going to sit and welcoming folks. Got to go face to face with a lot of clients I haven't either seen ever or just don't see them very often. So that was kind of nice, because we kind of started with Zoom for a lot of folks. So it was really nice to be able to have an event where everybody's out and it's not focused at all on investing, right? I do plan on having more client events. They will be just like that. It's not going to be investment focused. It's going to be more on relationship building for you get to know me get to know you, and just kind of break bread and enjoy an experience together, and build those bonds that help us get us through the tough times, like Q1 and Q2 of 2022. But we will get to that. Also, good news: the morning show continues on. Allison's doing a fantastic job with that, helping me out again, and she plans to. She starts in Alabama on August 4th. She won't be available during rush week, but after rush is over, she's got her class schedule, and it allows her to be present and continue to host the morning show. So she thinks she can do that. We'll see. Obviously, school takes priority, but hoping to continue her to host. If not, I have a backup host already. So we shall see how that plays out. But the purpose of the morning show, this is why I wanted to say this. So for everybody that's on here, again, thank you for attending, taking your time out to do so. But the purpose of that morning show is every day I collect in my brain, what are people asking me, during the day? And then I make a little note in my phone, send an email to myself. That's my archaic way of doing things. But I really do make notes as to what questions people are asking. And certainly if more than one person asks the same question, it's immediately going to be a morning show topic. So I'm trying to answer questions that people have asked and or answer the questions that you have yet to ask. So for all the investors out there that are maybe don't necessarily approach their advisor all the time, whether it's me or one of the other advisors on the team, we're trying to get in front of that. We will look over time to expand the show. We shall see. We'll have to talk more about that. But again, the purpose is to get those questions out there and keep it into a 8 to 10 minute format. So it's kind of an easy in and out. I think I will revive the podcast, so there will be an audio version only for listening in your car, that sort of thing. But we shall see. I have to take a look at how to do that. Okay, so new changes, for this past year, Ankerstar Wealth as a group, Obviously, we've hired a person. We'll talk more about that here shortly. But we're also redoing the contracts. You've seen the contract update questionnaire if you're a current client. I know you just did a contract. I understand and I empathize with you, but we still have to go with the new system. So that's why we're kind of redoing that. So thank you for your patience. But yes, we are going to kind of do that to get to more quantitative base management of your portfolio. And we'll kind of talk to why towards the end. And then talk a little bit more about the portfolio management changes that we have for you. So that's the intro. Quick disclosure, or not so quick, if you will, since it never is. You can certainly welcome to pause this presentation if you need to read this. All of our disclosure information is available at the website ankerstarwealth.com. In addition, what this slide tells you is that I am solely responsible for the contents of this presentation. These are coming from my head to the best of my knowledge and expertise to you as to what I think is going to happen in the world. I do not have a crystal ball. I don't propose to have a crystal ball. I don't expect to always be right, and there will be in times when I'm majorly wrong on certain things. However, it's the best that I know with the best that I know to put together your portfolio with the information I have at this time to set it up for success later on. When you think from a coaching perspective, you put the lineups together, you send the group out with the best players in the best positions. And at that point, you've set, Phil Jackson used to say, set the conditions for success. They don't always win, but you set the conditions for success. And that's what we do with portfolio building. You will see all of the standard disclaimers in there. You may lose money. In fact, a lot of you have lost a lot of money in 2022 so far, and all the other standard forward-looking things in there. I can only predict what I can predict, right? So therefore, that's enough for the disclosure. Overall here at Ankerstar Wealth, before we even get into the investments, I do want to foot stomp something with each of you that are listening. Is that in cursive, in italics, excuse me, their rapid response to client concerns. Here's what my staff and I try to bring to you as a client. If you email us, which is best, because that way that VIP services, almost all of us can see that and respond quickly, or if it's something directly for me, heavy investment related question or a personal question, they can immediately let me know that, hey, so-and-so has a question, and I'll build in some time during the day to address that. But we're trying to respond to you on anything you have for 24 hours. And when you think of why Ankerstar Wealth over somebody else, well, I will tell you, it's this. That's what I pride myself on. That there's a building in the future. It's now 2024 instead of 2023, but eventually we'll have a physical location. For those of you who I've sat down and talked any length of time, I do want to take it 24 hours where I have an advisor on shift throughout the night. Because when I want to come in the morning, I'm not going to the night shift. I'm too old for that. But when I come in the morning, instead of an entire to-do list that will take me to noon to exhaust, I would like to have everything already done. So I'm starting with a fresh slate when I walk in the door in the morning. So that's the goal. So if you're a two in the morning type person, or you're on the other side of the world and you ask a question, you should be able to get an answer or a time frame for your answer. That's what makes us different. We're also priced below the market price but I don't lead with price for my own personal advertising. But we're gonna start making more mention of that through some of our advertising and stuff that's out there. But again, that rapid response to client concerns is what makes us different. Now, it all does come down to the core competency of investing. There's investing and financial planning. Again, this is talking primarily to investing. Financial planning is almost completely separate, even though it's the backbone of investing. You kind of have to do all the other stuff. But we're not talking about Riskalyzer Money Guide Pro during this time and what it can offer from a financial planning perspective. What we are talking about is the pure investment management side of this. As you can see off to the side of the screen there's the assets under management. You say 45 million. You're like, Steve, didn't that say 50 not too long ago? And I would say, yes, sir. Yes, ma'am. Depending on who's asking the question, it did. And we are working on it. We'll talk a little bit more about bear market strategies here in a couple slides. But I will say that in a bull market, everybody appears to be a genius. In a bull market, everybody appears to be stupid. I will tell you that from a professional investing perspective, you work just as hard, if not harder, in a bear market. You're working hard all the time. You look for the same things. You're looking for what can make the most money. And in a bear market, how do we stop the losses, right? And then keeping that handful of, I'm not even going to go into what I really like once the market turns, because I don't know when the market's going to turn. So today we're just going to talk about how we're stopping the losses losses and lowering the drawdown of your portfolio, because that's, playing defense first. But then when you turn around, flip back long and go aggressive later on, that'll be a whole nother brief with things to take a look at. But you can see the assets under management as a few days ago, again, down significantly. When you talk the beginning of the year, we were at 49 million. We did spike up over 50 there for a while and came back down. But if you do some quick math in your head, 49 million at the end of the year to 45 million now, you're talking, you could ballpark that to 10%, even though it's slightly less. In a market that's down over 20%, I'm not going to try to slap high fives or say, hey, can you give me a gold star or a 5-star Yelp review or any of that stuff. All I'm saying is we are working and we are paying attention and we are trying our best to mitigate the downside during this time. And we know it sucks. Nobody's calling to tell us what a great job we're doing now. If anything, silent treatment's about the best I'm getting out of some folks. And, I'm not saying call me up, if you don't need to, but certainly if you have concerns, that's when you need to reach out. Obviously you may get a number of folks answering you now, but if it's a question specifically for me, you're going to get through to me, eventually, and I'll be the one answering your question there. But overall, assets under management is 88%. So again, that's stocks, bonds, portfolios through Charles Schwab. We also do assets under advisement, which is the standard 401k, 403b, TSP sort of thing, where we can't log in as your advisor. We can only have you send us statements, and then we tell you what to give you your allocation after we run it through our portfolio software. And then you have to go in and make the changes. Again, we only charge half of the normal fee for that. And then the last one is alternative investing. A lot of you don't know a lot about alternatives, but you probably wish you did when you hear this brief, because really the only things that worked in the second quarter of 2022 are the Blackstone investments, which are private equity, right? And there are some minimums associated with, and it used to be for the uber rich. Now it's just kind of for the kind of rich, and some of it's dropping down to the middle class with a few of the options that they have available. We'll talk more about that here in a minute. Standard investments, 337 positions overall. That's too many. We are taking a look at, you'll hear us talk about optimized portfolios and a core and satellite approach, which is how we're taking the risk number that you're putting in the contract and that risk range and building portfolios around that, and then having some satellite holdings on the side. So it's still tailored to you, that the core holding, the big muscle, if you will, is going to be locked to a risk number. And then the rest can kind of be the stuff on the edge where we're seeking to outperform. So more on that a little bit later. You can see the lay down there. The number in bold is the current allocation of the book. And again, I have to report these, so that's why you see them there. And not huge changes from the positions in parentheses, which were the previous positions. Or drop in equities. Guess what? I probably have more shares since there was only a 3% drop of the book. Actually more shares now, right? So I was a buyer of equities. I've been buying. That will go down in history as buying too soon. I hear you. But back, early May, I thought it was a time to buy, so I started buying. I'm still buying now. Like you've heard me talk about the bathtub and how much further is it going to go, and I don't think much. I can't guarantee it won't go further at all down, but certainly I think we're in the area of the bottom. And we'll talk more about that here in a second. Index funds, slight increase. Again, these are focused. Those ETFs are focused theme funds. I like cybersecurity. I like robotics, AI, that sort of stuff going forward. They may not make money in 2022, but they will going down the road. I'm positive of that. I can't guarantee it though, due to the nature of investing. You'd have an uptick in mutual funds. KDUX, which we'll talk more about, is included in that. And we're leaving that position. I'll talk more on the next slide. Increase in bonds. Again, that's probably just the bond value. Bonds tend to hold their value a little better during the market downturns. In a 60-40 portfolio, bonds would actually increase. That has not happened. But certainly, I'm not a buyer of bonds here, but holding on to the ones we have, unless I sold some of your bonds to put some risk on there while equity is sold off. And then cash right around that, just below 1%. That's kind of standard to have half to 1% laying around in cash. That's not a lot for your individual account, but that is a lot when you take it from the 45 million perspective. That means I do have almost always dry powder to put to work when I see an opportunity, like Apple shares below 140. Right. And then options, those are covered calls, again, that we've sold. So we're not really looking to go in with major option strategies. They're just getting that extra dividend or mitigating the downside, if you will. All right, over to the alternative investments. Again, Blackstone has been by far the big winner with both their BCRED and BREIT, which are private subscription investments, which again means we have to do paperwork outside of just logging in and buying them. BXSL, you can buy, I put that into some portfolios to where I can't get in to either you're not willing or not able to sign subscription paperwork. I can put you into that and again get you right back out of that. BREIT and BCRED do have some time frames associated with them for moving your money in and out. Self-directed IRA, excuse me, self-directed IRAs. If you ever want to buy a house out of your IRA, you can do that. Again, we will coach you through that. We do have to ship off that money to a self-directed IRA company who specializes in that. I have no desire to bring that specialty in-house, but being a fiduciary, and if that's what you desire to do, every advisor we have on our team will say, hey, here's your options for doing that. If you want to do it, let me help you. It's just not a service we can offer you here. We do have some VC opportunities. You see a couple of them there, more private equity to farm together, and then opportunity zones. If you're sitting on large capital gains and you're like, Steve, how do I have capital gains? My portfolio is down this year. Well, if you sell a business or you have a large portfolio in a taxable account, you might have received taxable gains at the end of 21. That sort of thing. So if you're looking to put capital gains and save money, put them back to work and investing, and not have to pay taxes on them, you need to use an opportunity zone, which is literally a multi-hour topic for another day. So I won't get into other than that it does exist. Okay, here's our top 10 holdings in the book. That's all I will talk to out of the book itself. The leader of the pack is still Apple. It has been the leader for a long time, and even though it dropped from almost 180 down to below 140, I'm still a buyer here. Many of you have enough, so that's why you haven't seen it in your account. But certainly, if you don't have Apple as one of your top positions, you will soon, or as soon as you bring your account over. That's how it's going to work out. All right, this chart, how you read it, is off to the right in parentheses. Tells you either the change, kind of like if you think the NCAA rankings, minus how many spots it dropped or how many spots it went up. Well, Buffer is a new listing. In other words, it was not in the top 10 after the first quarter, but the first quarter was brutal enough. We're well into our bear market strategy of getting rid of speculative holdings, focusing the portfolio on best of breed and then mitigating the downside. I had to start going into something to mitigate that downside. So I chose a fund called Buffer. You can read about it if you want, just put the ticker into Google and go from there. But it does it's an option hedge strategy to mitigate the downside in your portfolio. It still continues down and just doesn't go down as much. This is complete dry powder for whenever the market reverses. And I feel that the bottom is now officially in and the market's going back higher. So Buffer won't be there in 2 years when the market's hitting new highs, right? So if anything, it's a temporary position to, if you will, buffer the downside. So that's what we're doing for you. Amazon had it split back in the day. It did drop one spot because of Buffer. But again, one of the major holdings. I love the company. I think it will eventually get broken up and the value of the parts will be bigger than the value of the whole. However, the stock split, the much anticipated stock split happened and nothing. I mean, stock didn't move. So that's coming. Okay. It's coming. When the market bounces, obviously, I believe Apple, Amazon, and Alphabet will lead the pack higher. So it's coming. Just be patient. For Google, number 4 holding there. Again, their stock split's coming up on July 15th. That is a 20-for-1 split, just like Amazon. I expect the stock to scream higher with a parenthesis or with an asterisk. I expect it to scream higher when the market finally starts going higher. Right now, tech has got this Kathy Wood kind of gave it the big Black Widow bite. To crush tech. So tech's not going higher anytime soon, unfortunately. But I think that almost all Ankerstar wealth investors and most people in general realize when the market turns and things go higher, the tech is the leader, right? It's the big loser right now. It's the leader when things turn around. So that's the thesis anyway. Okay, there's your KDUX. You can, see the full name there. Dropped a couple of positions. We're completely out of this on July 14th. Nobody can act on that information. So it's not me disclosing anything because you can only get out of it once a quarter. And that's the biggest problem. And that's why the only reason I'm really leaving this holding is because of liquidity. You can only get access to your money. So the type of folks I put into this are now all of a sudden saying, hey, I want to get cash out my portfolio. And I'm like, I'm sorry, I can't till July 14th. I don't want to ever have to say that to somebody again. So we're out of this particular holding, and it's mutual fund. There's better out there. The Blackstone positions in BCRED are better, and then BXSL is better, and won't return quite as high, but at least you have the liquidity. And then K&G is a new fund we're using, an option strategy around the dividend aristocrats. You'll start seeing that pop up in your portfolio. Not enough to make the top 10 here, but certainly after we're out of KDUX, the number 5 holding, you'll see probably one, if not both of these holdings in the top 10 in the next quarter. All right, cybersecurity is the top theme out there. Again, thematic ETFs is part of that direct indexing where you're not looking to take the whole market. You're taking a portion of the market and investing heavily in it. I think cybersecurity is here to stay. You've heard me say that a million times. RDVY, rising dividends, as well as if you skip down to below that, the mid-cap rising dividend, SDVY. Both of those are great holdings for a volatile market. They have companies that issue dividends, have issued dividends for a long time and haven't cut them. Yes, they drop with the rest of the market, but they don't drop nearly as far. Okay, Blackstone, I skipped over BCRED for a reason. I just wanted to talk briefly. This has been the best holding out there. Fortunately, the Ankerstar investor funds are almost entirely in BCRED. It's up around 7% for 2022. So I have several clients in it, but there are some minimums associated with it. It is people that are in this generally put 250K or more in. That's not the min, but generally a sizable position in this, and that becomes an anchor in your portfolio. If anything, Blackstone's good at it's taking advantage of volatility and distressed assets, right? Okay, last one there, robot, ROBT, artificial intelligence. That's the wave of the future. I don't think anybody doubts that. Not because Westworld season 4 just came out. Haven't seen it yet. Don't spoil it. But that is the wave of the future. Everything's getting smarter, more robot. I mean, we all know that. That's where it's going over time. That's going to be a major money maker. You just have to be patient because it sold off hard. And then what fell off the list is the diversified real estate, PPTY. We had that as a huge holding last year going into the inflation. Pretty much scaling that out of the top 10 already for sure, and then probably continue when I need more money for something else. That's where I'm looking to get it from. All right, investment themes. There's your ocean of red. What worked? BCRED, BREIT, and KDUX all worked. Black Rifle Coffee Company is kind of the funny story there off to the right. We'll get to that in a second. But again, shifting to that reduced volatility. The big issue with, we'll talk about the death of the 60-40 portfolio. In portfolio management, they've taught for decades now that you want to, 60-40, 60% stocks, 40% bonds. When one part of the market sells off, the other portion goes up. Well, that doesn't work. It didn't work in 2018 when the Fed raised interest rates. It didn't work with COVID in 2020. It's not working in 2022. I don't think it'll work next time either. The market has become so emotional that it's either all up or all down. Well, that I won't say that quite kills off diversification, but if the whole theory of diversification is always having to say you're sorry, meaning if most things are going up, there should be something going down in your portfolio. If there's not, you're not diversified. Well, everything's going up and everything's going down, right? So with that, I think you don't have to be such a slave to the 60-40, which is your traditional, Edward Jones, LPL type advisor are going to put you into those models, right? And they're going to go age, risk tolerance, here's your 60-40, goodbye. I think that's not working. And I think people are noticing that it needs to be more hands-on and paying attention to what's going on. So you have some, factor investing that creeps in there, some direct indexing, which is on the next slide, and some thematic investing, which all of this is really thematic stuff. So when you see the things up here, these are things that we are still going to invest in Q3. We're still reducing volatility because I don't know where the bottom is. The metaverse has been slaughtered. That's Facebook, Unity Software, Roblox. I love it. I think it's going to be a major player in the future. There will be a time to take the chips and shove them in the middle and take advantage of the huge move higher into the metaverse. That time is not today. I don't know if it's Tuesday. It's probably not Tuesday either, but it's coming, right? It stays on the investment theme list, even though there's not much money behind it right now. Cybersecurity, undoubted that cybersecurity is going to be a player till the end of my life. Hopefully that's a long, long time. Hopefully the end of your life too. Real estate, sure, inflation protection. Most people have exposure to that through their private homes. However, that's why the PPTY holding was in there, and I think it's already run up enough to where we can diversify out of that. Artificial intelligence we talked about. Online retails, Amazon and iBuy, those sorts of things. Clean energy and healthcare aren't going anywhere. Technology has been killed. It'll come back. Data management, that's more of that cloud storage. Data is the new oil theme, which you hear me talk about. I will continue to say that data is the new oil, right? So anything that's involved in data management is going to be a moneymaker, even though the first half of 2022, that did not hold. Financials, they take advantage of the interest rates going up, their net interest margin. Their loans are already charging more on their loan interest, but are they paying you more into your savings account right now? No. It's like Starbucks, you know, coffee beans go up, they raise the price of your coffee $1, but they don't reset it when the coffee beans go back down, do they? Same thing with banks. So the difference between what they're paying you in your savings account and what they're loaning out for loans, they keep the difference, right? That's how small towns with 10,000 people have 10 banks and one Taco Bell. National defense infrastructure, you see some other names there. Last thing I'll talk about on this slide, obviously some things to the right are kind of the highlights. Crypto, we're out for now. Yeah, I do believe crypto. I've always said Bitcoin and Ethereum have a place in this world. It does not have my dollars behind it right now, nor is it going to get yours. We got to wait. We got to wait and see how this thing plays out a little bit. You know, the Bitcoin 100,000 thesis, Bitcoin zero thesis. I don't know. I'm going to continue to watch from the sidelines until more information becomes available. I believed and now I don't. So we're on the sidelines, but I won't hesitate to put money back to work in that space at some point in time. Black Rifle Coffee Company, if you were in it, what a ride, right? We were in it under $10. We knew about the SPAC. It was diamond something or other. We rode it up to 30, peeled off some at 30, and then it's back down below 10. I mean, what a ride. We're out of it. Excuse me. We're mostly flat unless you are somebody that I think has either an emotional or physical tie to the Black Rifle Coffee Company. But again, it's if you still have it in your account, it's a small amount, and there's definitely a reason. Okay. Forecast. Let me talk real quick about, we know that 2022 was the worst start for the market in 52 years. 1970 was the last time we had a sell-off commensurate with what we've seen right now. 1970 ended the year an up year. I did a morning show on this, I don't know, sometime in the past week or so. 1970 was an up year after starting down 21%. I'm not going to tell you 2022 is going to be an up year, but I will tell you that when markets bounce, they bounce fast. And that's your biggest reason not to go to the sidelines with your investments, is because when the recovery happens, it screams higher. And even if you're staring at the screen, it doesn't mean you have the stomach to hop back in when the time is right. So why sell and try to buy back in later? So allow me one analogy, and I will go back to this chart. If Apple stock over a 30-year period returns 2,000%, and you did this magnificent sell it all and buy it back 3 months later move to where you made, I don't know, an extra % or two, you know, why take all the risk of missing that? And to be able to tell your friends 30 years from now that you returned 2,002% on your Apple shares. Why take the risk? There's a far bigger risk of you missed the upside. And now after, 30 years, Apple's up 2,000%, you're up like 1,100% because you went in and out of it several times, even though nothing changed with Apple, right? So why try to do that? You can do that around the edges, get out of the speculative stuff, no doubt, but certainly you don't need to do that with your core holdings. Okay, let's talk about the quarter in review. Continued inflation. We thought we were past peak inflation. We were not. Fed rate did raise rates 75 basis points. They are projected to do so again in their next meeting here later this month in July. Taper tantrum, that's the bond buying program, excuse me, the undoing of the bond buying program more accurately. And the Ukraine-Russia conflict continues on. I thought it would last weeks. It's gone into months. I was wrong. It's here. I don't think it lasts forever though. So really a continuation of the sell-off we had of Q1 kind of continued into Q2. So what's ahead in Q3? I still think we're going to see significant volatility. Rate hikes will continue until there's a significant reason not to. Right now, if anything, rate hikes are going to increase. We've got a 75 basis point rate hike baked in, and then the rest for the year, another 50 basis points. So if you add all those up, you're talking, rates significantly higher than they are now. The market will turn to go back higher when the rate stops, when the Fed stops doing what they forecast that they're going to do. Okay. The taper plan will need to play out. I do think the Ukraine-Russia conflict ends this quarter. I just don't think it can continue for both sides. Secure 2.0 should pass before the election, and tax reform that we all thought was going to happen from the blue wave a couple of years ago is not going to happen. There's zero chance the Democrats throw out a tax package just prior to the election. So we talked about the one in bold there. Okay, the remainder of 2022, here's what I think happens. The Fed will stick to their guns and overshoot where they need to be. That's the prudent thing to do, honestly. If you and I were on the Fed board, that's probably what if we were going to err, we don't want to err by not doing enough. You want to err by doing too much. In a perfect world, yeah, you'd nail it right on the nose, but we don't live in a perfect world. So I think they will overshoot to the upside, means they will raise rates slightly higher than they need to. There will be a ton of political posturing will dominate the news cycle, pointing fingers, who caused this, who caused what, blah, 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 into the election. And then we'll have the elections. Okay. After the elections, I do think the market will settle down some and go back higher, almost independent of who's elected. So kind of happened with Biden getting elected too. Market went higher. It's like, okay, you wouldn't normally think that with a blue wave, but they got it. It's more of a certainty versus uncertainty type of situation. Looking out, boy, making a 1 to 3 year forecast is almost a fool's game. But I do think the economy accelerates after the elections. The markets will adjust, reprice everything in. Inflation will finally subside to where we'll get that pause in rate hikes. When we get that pause, or the Fed has a meeting where they don't raise the rates as much as they said they were going to, that's when the market screams higher. I don't know when it is, neither do you. That's why you stay invested through the bathtub here. And there will be significant discussion of lowering rates again by election winners, people wanting to be nice to their constituents, right? So we're electing a whole bunch of new people in November. By the time they take office in January and we overshoot to the upside, there's going to be a call across the board. Let's lower rates and get the economy going again. You've seen this movie. When that happens, the market goes higher. Okay. The decade summary, again, there's no reason to think that returns of 20% are going to continue. We were spoiled there in the, from the run up during the 2010 to 2020, kind of a straight line up. I would not expect that. I would expect more volatility, and 10 to 12% is more likely. I do think that most of that return will continue to come from a few firms, not the overall market. This is not just time to buy the SPY and go home. There's times to do that. If it's too crazy to pick out best of breed, then don't. You just buy the whole thing. If you can pick out best of breed, and I think they're fairly obvious, then do so. I think there will be a breakup of firms that outperform, i.e. if Apple and Amazon and Google continue to scream higher, they will all get broken up. Absolutely. And they'll be worth more in other broken up parts. So I'm not scared to hold them into a breakup. And I do think, especially with crypto, if crypto goes to zero, something else will replace it. Right. So there will be more speculative stuff, and we have NFTs out there now. I mean, there's going to be, when people can take their smartphones and create something and then start pumping it, saying this is the future, money flows behind it and off you go. Right. So there's going to be the next big thing. I would say, have fun with it if you want. Take the AMC ride. If there's another AMC out there, crypto, whatever, that's far more gambling. Do it for fun. Don't do it with your future is my take on that. Okay. Here's our new member of the team. So it took a long time to get to this portion, but we're done with the investment piece. Joel is a friend of mine from way back. We met back in 92, if you will. We served our country together. Joel stuck it out about 6 years longer than I did. Got some more rank, and then hung up his cleats about 6 years ago, went into the private industrial commercial side of it for a while there. But if you read through it's too small to kind of read here, but if you go to our website, you can meet Joel and read through that. But his passion for investing, it was apparent to me at age 22 how we were both passionate about it, right? So here we are, these young kids, young lieutenants, if you will, working in these jobs. But what do we keep talking about? We started our MBA classes together at the University of South Dakota, and we talked investing like all the time. Joel's very well versed and an expert in real estate. He's built his empire, if you will. I call it an empire. Building it through real estate and rental properties, as well as the markets. So mine's almost entirely been through the markets. So it's a good balance of expertise, and we're certainly welcome him to the team. You also see the network up there. We do have Jaden. Still, even though he's obviously got some school responsibilities there, but often if he's answering an email or fielding your question, that's coming from me. That we sit next to each other in the office. So a lot of times he's just handling some of the stuff for me. He's a fully qualified advisor. And then we have David Johnson, who takes care of all of our insurance stuff. So if you ask Joel, Steve, or Jade an insurance questions, we'll give you the CFP, / Series 65 type answer. We can give you the broad view, but if it goes anything expert, or if you're actually looking at buying a product, we'll send you to David, and he's licensed in most states. So welcome aboard to the team, Joel. Not only as an advisor, not only as a client, but also as an investment board member as well. Okay, here's the key concepts I will leave you with. Gone a little bit long-winded. Normally these are about 40 minutes, so I've got just a few minutes left. Look over there in the green. This was kind of funny. Not funny, but I went to an investing conference in Fort Lauderdale right after school let out. So that would have been the first week of June, and kind of talked a lot of theory there. And there were a lot of major players in the industry. There were some outside of the industry. Not Peyton Manning, but Eli Manning was there with his dad. And they were talking, investing and what they have on their mind, how to deal with high net worth investors, that sort of thing. So great conference, but a lot of it was talked about what value you add. What do you do for your clients? Why are your clients paying you? Why do they hire Ankerstar Wealth or anybody else? Why do you go to Edward Jones for that matter? Really, and to put it into words, it's off there in that green box, is what an advisor does for you. There's the compensation. The compensation is a fee that comes through the assets under management, blah, blah, blah. But that's not the value that's provided. The value is make you much money as possible within your risk tolerance and capacity. I won't go into what risk capacity is, but you may have your tolerance may be high, but your capacity for losses is low, right? So therefore, that would not be prudent to go into a high risk strategy. But whatever fence, and that's what that new contract helps tying that to a risk number, is it allows us to kind of focus the majority around the big portfolio, and then we have tactical flexibility around the edges to maximize that return. So that's what we're trying to do for you. You can see the small changes in your portfolio, trying to maximize that return largely on the edges. And then secondly, we try to coach and mentor you through volatile times to avoid making mistakes. What would be a mistake? To go to cash. I did have a client say, I was seeing if I lifted on this slide here. I did not, but basically it was yesterday. Client said, if this gets worse, we'll need to get out of equities. Or if things really get bad, we need to get out of equities. And the time to get out of equities is when things are really good, right? That's what you meant? He's like, absolutely not. And I'm like, well, that's why you have an advisor, right? Is you don't lock in losses when everything's low. That's like, treat it like, stocks or assets. You want to buy them low and sell them high. If you were to blow out of equities, it would be if the market literally, say next week, the market goes up 50% every day. Well, we need to be in all cash by Friday because we know that that's not even possible that that's going to hold, right? So you would want to go to all cash when the market's an all-time high and in a clear bubble, not because stocks are on sale. And that's why, when people say the rich get richer and it's not fair, it's like, well, rich do get richer. I do agree, but it's because of things like this, that people have largely, outside of their house, their portfolio is the largest thing they will ever have in their life. And if they decide to fire sale it to somebody else, when the market sells off, guess who's standing there with their hand out? The rich. And then they get richer when the market, the market's undefeated on going back higher. So that's how that wealth transfer passes. And it happens through these dips all the time. Advisors try to keep you focused on the long term. If you need to do some cash flow decisions, selling to free up some cash, do it. But don't take the whole, throw the baby out with the bathwater, if you've heard that analogy, sort of thing. And then if you do, mitigate the damage of those financial mistakes. So if you're insisting on taking a portion or all of your portfolio to cash, we try to mitigate the damage that you've done to yourself, to kind of, and then try to work your way back into investing at some point. So that's what we do for you in the green. Bear market strategy, we already talked about, get rid of the speculative, focus on best of breed. And then really you want to buy more along the way. And people are like, well, I don't have any more money. It's like, well, if you don't, you don't. But if you do, like you are working and you putting in your 401k every month, you are buying through this dip. If you have $500 a month coming into Ankerstar Wealth, you are buying through the dip. You don't make an attempt to call the bottom, but there are several folks, and some of you are listening, you were putting in a monthly amount and then the market starts to sell off and you're like, well, if my portfolio is dropping more a month than I'm putting in, I feel like I'm throwing that, money into the fire. And I'm like, it can feel like that. Yeah, but you're not. You're buying more shares and we haven't sold any shares. right? It's the value of the shares that are going down, not the number of shares. So no, you want to just buy through these things. These things happen, and we'll be out the other side and going back higher at some point in time. I just don't know when. New contracts. Kind of talked about this. The risk number comes from our relationship, meaning if I've worked with you for several years, I already know your risk number. Questionnaire, if we need it, new client form or contract update form, that's what you got in DocuSign. Thanks for your patience on that. No questionnaires are perfect. So some of those questions, I got it, they suck or they don't apply or whatever, just do your best. Anyhow, it provides a risk target. So ultimately for your portfolio, if you are aggressive, you might have a risk score of 77. And then your risk range might be 60 to 90. Well, 60 to 90 is that tactical flexibility. When I get emails that say, Steve, I'm paying you to be able to adjust my portfolio. Well, I can adjust it, but I need to be bounded, right? I can't just, move all over the map. And I've been doing that, but it's, with your portfolios, but it may not make sense to you what's going on in your portfolio if you aren't seeing any math to back it up. And I don't get to go just off a gut feel. I go into Riskalyze and I look at the math, but that's what I'm doing anyway. So since that's how I'm managing your portfolio, I can communicate it to you by, hey, your risk is 77. We talked about a risk of 60 to 90. We meet and I have a risk of 61 for you right now. I'm like, we're at the bottom end of that. We're mitigating the downside. We're going to go up to 90 in November when this thing turns. If it turns and screams back higher, then we're going to be at 90, but I'm staying within that range. That's my tactical flexibility. That's where I can use, so we can use our expertise to really take advantage of the markets, but we still need to be within a range. If you're not within a range, you can get into this all in or all out mentality, and that's just not helpful. Also, it allows folks that are pretty conservative from taking a whole bunch of risk when it doesn't work out, they're like, well, why were we taking so much risk? I'm like, because you called me and said, take more risk. I'm like, well, we're not doing that anymore. You have a risk range. If you want to renegotiate the risk range, then we need to meet and do a quick paperwork update to the, one pager up to the contract and fix it. Right. And that legally opens the range for me. But then you've signed it at that point. So you know why I'm taking more risk. Okay. We talked about direct indexing and the death of the 60-40 index. I will not talk about that other than it hasn't worked this year. Didn't work in 2020, didn't work in 2018. Okay. The retail investor, again, this kind of goes off to that left slide of what we try to help you through is bear market emotions. At the beginning, the bull's screaming along. Everybody's brilliant. We're all slapping high fives. People are buying stuff and people are buying stocks that are ridiculously overvalued, like Tesla. And they always think we're going off to new highs. Even, market drops 3% from all highs and people are like, buy the dip. Diamond hands. It's like, oh my gosh, you haven't had your diamond hands tested there, kiddo. If you think 3% is, if you got the diamond gloves on, no. Now you might think they're being tested down to 20 or 30, 20% with the overall market, 30% with tech. But yeah, people are still a buyer during that initial dip. And when really things need to be looked at, like, how do we want to keep the position of portfolio moving forward? And then when the sell-off starts to pick up, they tend to hold through that. Which is really that time to sell. When you hear me use the roller coaster analogy, is when you're peaking at the top. I mean, nobody sells right at the very top. Never try to do that because you can scream higher. But certainly when it starts back down, that 5 to 8%. So again, using math to back up our investing strategy, that 5 to 8%. That's the decision time of, do we get off of this coaster? That's when you adjust risk, and that's the bottom of the coaster. If things continue to go screaming down and you adjusted your risk, then it won't be down as much. If you don't make any adjustment there, which is again, the retail thing to do, then you take the full run down. That's like people that buy the SPY and go away. You're going to take the full ride. And if you can have the stomach for it, enjoy it. But if you don't, then you could potentially be setting yourself up for a mistake. Then you get to that third phase, this sucks, never be able to retire, take years to get my money back. That's kind of where we are. So I hear something new every day. It is what it is. A bear market strategy. We are holding only best of breed. If you want to call me and challenge me on any particular holding you have in your portfolio, I can tell you in 30 seconds why it's in there, right? And why we're holding it and why I have no intention of selling it down here. And then we're going to look to buy, right? New money comes in, we buy. If we need to remove some stuff around, we'll sell off buffer, we'll sell off king, and move back higher that way. But back to the slide here, you get into this sucks. And then you get into the don't look phase. which I know many of you are there, which is why you hired me, right? I look so you don't have to. And then you go numb. Well, don't go numb because, at that point, hold because it's all stupid anyway. And you see people do that with different holdings that have lost so much. Like, well, I'm not selling now. It's like, okay. But anyhow, those are all things advisors can help you with. We here at Ankerstar Wealth see this stuff all the time. We talk folks through it. We empathize with the emotions that go on. We know, especially if you're nearing retirement and you're seeing huge moves in your portfolio, we empathize with that. We get it. It's just really, we need to move away from the emotion and mathematically chart our way forward. And we have all the tools we need to set you up for success there. All right. I'm losing my voice. It must be 40 minutes. So thank you so much. I'm looking at the Q&A. I see no questions in the Q&A. I will wait just here about 30 seconds to see if one pops up. But I do want to announce, mark your calendars now, October 5th, which I believe is a Wednesday night at 7:30 to 8:30 will be our next investment advisory board meeting. And by then we will have a charter out for the investment advisory board, as well as some objectives. And then we'll codify some of that into our brief to add a little more structure and mature this a little bit. But again, the benefit of me throwing this out there is that again is at least a quarterly insight into what we're looking at here at Ankerstar Wealth for the major themes going forward for quarter three. We can't guarantee you that it's going to be a big turnaround from quarter two, but as the elections approach, I'm more and more optimistic that we are finding the bottom. As the interest rates get hiked by the Fed, I'm more optimistic that we're in the vicinity of the bottom. So things are happening. They're good. A lot of negativity was baked in. And I think that we do have the ability to eventually turn around by the end of 2023. We shall see how much before that happens before the election or if it waits till after the election. So, all right, that's all I've got. No questions. So thanks again for attending. And with that, you guys enjoy the rest of your day. Bye.